I've been putting money into a Roth IRA account since it first became available back in 1998, and when the maximum amount we could contribute was $2,000 per year. And if I could do this all over again, there's one thing that I would do differently, and I wanted to share this with you. And I think it's important to know, particularly for the millennials, because it would most benefit folks who are young and can keep their money in a Roth account for a long time. And so I have three important tips or advice regarding Roth investing. The first and the most important tip that I want to impart based on the mistakes I've made is that you should invest your Roth IRA money in an index fund that tracks the S&P 500 or the Wilshire 5000. And don't move that money around, meaning don't sell those shares and go buy shares in other stocks and keep trading shares in different stocks with the money in your Roth IRA account. Only buy and then hold in an index fund. Not buying and holding in an index fund was my biggest mistake. So for folks who are not too familiar with how this works, Roth IRA is a retirement account to house whatever money you squirrel away for access or to draw on later during your retirement years. But how you invest that money will determine how much that money will grow in your Roth account. I invested that money in a variety of different stocks, and I actively traded shares in those stocks and made some poor choices, resulting in some of my stocks losing all their value because the companies that I had invested in went bankrupt. So even after consistently squirreling away maximum allowable contribution year after year, I had very little growth of my Roth money. What was in my account was only a little bit over the principal that I had put in. You should hold that money in an index fund until you retire, say 30 years or so, to ride out the market ups and downs. If you're going to buy and hold for, let's say, just 10 or 15 years, then all bets are off, and you may not see the multiple-fold increase in your money that you hear all these financial advisors on YouTube talk about. You may actually end up losing money. That's why this advice is most relevant for the millennials who have time on their side to ride out the market volatility and allow the money to grow. So this illustrates what I'm trying to say. Let's look at this chart showing S&P 500 growth over the years. If someone started investing in 1996, and then decided to pull out their money 15 years later in 2011, they would have seen very little growth of their funds beyond what they put in. So if they put in, let's say, around $50,000 over 15 years, I think they would find that their money did grow or grew to maybe around $60,000. I didn't do any math calculations. I'm just eyeballing based on this graph, and definitely not hundreds of thousands of dollars more. That's because unless you've timed the market and bought only when the market was at the bottom, shown by the red arrows, you will have bought shares when the prices were much higher than the share prices when you sold in 2011. And if you had to pull out your money in 2011, you will have taken out the funds before enjoying the steady growth of share prices seen for several years after that. Now, it turns out that this first tip is a three-parter. And the third point is that you need to dollar cost average. What this entails is buying a fixed dollar amount of shares in the same fund at regular intervals over a long period of time. So instead of contributing lump sum once per year, you should divvy that amount and contribute smaller amounts every month or every 2 weeks or maybe even every week. This is to minimize the risks associated with poor market timing. You need to put in practice all three of these activities for this to work in maximizing the growth of your retirement savings while minimizing the risks of investing in the market. The second tip is for folks who earn too much money and are not allowed to contribute to Roth directly. As you become more successful in your career over the years, many of you will reach an income level where you will not be allowed to invest in Roth IRA. When I first started investing in Roth back in 1998, that amount was $110,000. But the income limit has increased over the years, and it is $137,000 for those who file taxes as a single filer in 2019. Once your income exceeds that limit, you cannot contribute to Roth directly, but there is a way you can still contribute to Roth. And here's how to do that. Just open up a regular IRA account in addition to the Roth IRA account. Deposit after-tax dollars. In other words, pay tax on the money that you deposit to the regular IRA account and request your broker to do a conversion to Roth. What that means is just transfer those funds from the regular IRA to the Roth IRA account. Now, I made it a practice to do this conversion immediately after depositing my contribution, so I didn't have to worry about paying taxes on any growth that occurred in the regular IRA account. So I currently have an IRA account whose balance is just zero because I use it as a vehicle to make my Roth contributions through it. My third and last tip is that you can withdraw some or all of the money that you put in to a Roth IRA account, and you can withdraw this money anytime without penalties or paying taxes on them. With a regular IRA account, when you withdraw money before you reach age 59 and a half, you have to pay a 10% penalty and taxes on whatever amount you take out. But with Roth, you can take out whatever amount you put into the account anytime without any penalty or taxes because you had already paid taxes on those contributions. Now, money that grew from your contributions, if you take out beyond what you contributed, you will need to pay penalty and taxes if you withdraw it early. That's before age 59 and a half. So this money can be a source of emergency funds, and it's definitely better than going into credit card debt. When I started investing in rental properties a few years ago and needed cash, I actually took money out of my Roth account instead of borrowing from a bank because when you borrow money from the bank for investment property, the rate is actually much higher. And for me, that was a good strategy because I began making more money from my rentals than the rate that the money was growing in my Roth account because I didn't follow my tip number one. If I had been steadily investing in the same index fund as I'm advising the young millennials to do, I probably would not have taken the money out. Now, there's a caveat, and it's that when you withdraw money from your Roth account, you can't replenish it and put whatever amount you took out back in. So that's it for this video, but I will be uploading other videos on retirement planning. So please subscribe if you found this video informative.